The gangbusters returns so far of Beyond Meat. Do you see that as an outlier, or do you see that as, as something that other potential IPO candidates are looking at with hopeful eyes right now?
Well, look, I think if you go beyond Meat, if I may, for a moment, if you look at the overall IPO picture, you've had some that have done well, some that have done poorly. It's about time that these companies have come to market, though, because they've been private for so darn long. So if I could maybe veer the discussion just one way for a moment, which is to say that we need to be blaming the Fed, if we can, for the results we see in the IPO market, which is there's been a decade of free money that's flown into the financial system, and that's pushed private valuations ever higher. It's de-equitized our public equity markets along the way. And frankly, we've had very little mechanism for finding out what a true price is. So whether it's high or low, to me, this is a good moment, 2019, for the IPO market. We can finally get a true sense of what these companies are worth, absent basically 10 years of Fed intervention that we've had.
Yeah, Phil, it's a good point there, the impact that the Fed has had on the private market. Certainly, we've seen record amount of capital going into the private market in recent years. Do you see that continuing to happen here, or do you see some of these companies starting to go public sooner, given the reaction we have seen in the public markets?
I mean, I think that the latest slate of IPOs has certainly raised people's eyes about, well, what is my company going to truly be worth? But you have to keep in mind, the world of 2019 is so different than even the world of 10 years ago or the year 2000. Companies don't need the money, generally speaking. What they need is the liquidity. So they're not necessarily raising capital. They are getting a mechanism to get their capital out. And so, to me, as long as that's going on, they'll keep doing it. Yeah.
Phil Libin, how has this late-stage capital boom changed the Valley? Has it changed it appreciably from where you sit?
Yeah, I think there's been a good evolution, and I think this previous point is totally right. The point of IPOs isn't really so much to raise more capital; it's to get liquidity, but it's also to have credibility, to have more transparency, to make it easier to attract talent and to hire people. I think we have to keep in mind the long view. Companies going public are a very good thing. They're supposed to be public. They're supposed to be accountable and transparent, and you're supposed to be able to buy into a company whenever you want and can afford it.
So does something need to stop this flow? Does something need to stop this flow of late-stage capital into companies that stopped them from going public earlier? Do you see that as a problem?
No, I don't necessarily think so. I think there is a big disconnect between the timing that the public market expects and what tech companies operate in. Tech companies, especially in their first few years, they have to make very long-term plans, right? They have to plan for things that are years out. Public market doesn't really reward that, right? The public market is trading based on what they can do by the end of the day, or maybe by the end of the quarter if they're lucky. So being able to delay subjecting yourself to that kind of time pressure, which isn't the time pressure you're making decisions on, is important. So I think there's an important role that the late-stage private capital plays in letting companies get ready to be in public market time pressures.
Yeah, John, I don't know. Yeah, go ahead, please.
No, I was going to say, if Phil's right and companies are meant to be public and they want more credibility and they want to be more visible and more transparent, then why do we see the big ones, the important ones, you could argue, come to market with ownership and ownership structures that are, I would say, put individual investors at a disadvantage?
Well, because frankly speaking, the market is willing to tolerate those structures. If they weren't, they would not buy the shares, and they are buying the shares. And why are they willing to buy the shares? This gets to my earlier point, Carl, about de-equitization in the stock market. So in London, the amount of shares available to the public, amount of float available to the public has declined 20%. In Frankfurt, it's 45%. We know the famous figure, 7,500 public companies in the 1990s to basically 3,500 companies today. So basically the answer is you've got no choice.